Warren Buffett's Berkshire Hathaway recently disclosed that they were doubling down on two positions, increasing their stake by more than 100%. These are both multi-bagger stocks that have gone up over 1,000% over their tenure, creating a lot of value for shareholders. And I think this might be validation from Warren Buffett's Berkshire Hathaway, suggesting that that track record, maybe that train keeps on going, creating more value for shareholders in the years ahead. Let's explore these two positions that Berkshire Hathaway doubled down on in the recent quarter. My name is Daniel. You're watching Unrivaled Investing. If you enjoy educational investment content, I do appreciate you hitting that thumbs up, hit that subscribe button. So the first company that he more than doubled a stake in is Constellation Brands. The ticker is STZ. And so when you're looking at this, once again, a stock that over the last 2 decades at one point was up over 1,000%, more recently closer to 700%. So this is clear multi-bagger status. These are the types of companies that I'm looking for. But zoom out close to 1,000%. Look at the last couple of years, so zoom in a little bit, and you see it's actually treading water, dead money, down a little bit, around 20% over the last couple of years, 2-3 years. So investors are saying, well, what's going on here? Buffett's starting to buy, saying, yeah, this actually might be a value, and putting in more than $1 billion in this recent purchase. And so when you're looking at Constellation Brands, you're looking at 15 years of volume growth in their beer portfolio. So this is a beer, wine, and spirits company. And you can see the different types of brands: Pacifico, Corona, Modelo, various different types of Mexican beer brands that have, crushed it over time. Also in the wines and spirits, historically, they've had like Kim Crawford and Mi Campo. Personally, I'm a bit of a teetotaler, so I can't really vouch for any of these brands. But if anyone has any sort of thoughts on the different, portfolio of sort of the wines and spirits that they've historically owned, love to hear it. That said, when you look at the financials, look at the numbers, this is really a beer company because, you could see the last 2 years, beers generated around $3 billion of their operating profit, whereas their wines and spirit, that was closer to $300 million. So you can see it's effectively 1/10 of what you're talking about, 1/10 the size of beer. So really, beer's the driver here. And you could also see beer's been growing much better. Profits grew around 10% versus a 20% decline for wine and spirits last year, looking at their fiscal year ending in February. And even worse, their beer business seems to be holding up, but the challenge is that their profitability dropped significantly from around $3.5 billion to around $300 million last year. And so why was that? Largely due to a non-cash, around a $3 billion non-cash impairment, particularly around their wine portfolio, writing it down, saying, the growth's just not here, and getting ready to sell it. I think it's selling their wine portfolio to a company called the Wine Group, I think. I think another key reason why the share price, has lost some of its value is you could see the outlook has also changed. You could see that previously management was guiding to around 6 to 8% growth. Now they're talking about 2 to 4%. So that does reflect, a structurally lower growing industry, where the wines and spirits coming under pressure, expecting maybe flat to 3% growth, whereas beer previously expecting 7 to 9%, only expecting 2 to 4% now. So that is, it's not just wines and spirits, it's really broad-based that they're expecting lower growth broadly. And that's what's a key aspect for why the stock has been dead money for the last few years. Now, looking at it, so far, beer has been holding up. In most recent fiscal year, you could see that they had both volume growth and pricing growth. And that's what Buffett loves to see. He loves to see that pricing power where they can, say, we not only sell this, but we're able to pass on our inflation costs and maybe get a little juice, because of the brands. You want to get your Pacifico or you want to get your Modelo. But you look at the wines and spirits business and it's been very tough. Not only have you had divestitures, but you've had, a decline in volume and declining in price as well. So that's, triple sort of heading in the wrong direction. So that's why the wines and spirits business has really been underperforming. But beer overall, it's a great business. And Buffett has a long track record of actually investing in the beer business. Long time ago in his shareholder letters, he was talking about owning Guinness and why that was one of his, this is actually when he was running his hedge fund, I believe. So many years ago. So he's long been a fan of it. And so so it wouldn't surprise me if Buffett's actually the one buying Constellation Brands. And you can see that, look, the beer business for Constellation is also doing well. You can see around a little under half of their sales, go to the actual cost of producing it. That's this bar. Then you have a little under 10% for marketing, around 5% for actually running it, the people running it. And then that leaves around 40% expected profitability. And not a lot of businesses have 40% type of margins. This is a special brand. That's what attracts Berkshire to these types of businesses when you have a stable and growing brand. And you can see that it's historically generated a lot of free cash flow, around $3 billion in free cash, or $3 billion in operating cash flow in 2025. They have been investing in the business, and they do expect their operating cash flow to, start moving higher, very low single digits, I think, over time as they're able to scale, and continue to grow their beer brands with a little bit of volume, a little bit of pricing. They are taking a lot of their capital and investing it in the business. You could see each year around $1 billion goes back into the business. A lot of that's just from, making sure your breweries are working correctly or even expanding your capacity. That said, given the challenges in the beer, wine, and spirits, industries, it's unlikely that you're going to see a lot more expansion capital. So you're going to see, their CapEx actually decline a lot in the years ahead. Wouldn't surprise me if it goes from 1.2 to, maybe closer to 500 million in the next couple of years, in which case their free cash flow could actually move significantly higher. I think that's another key aspect for why, Berkshire and Buffett has been interested. So looking at Constellation Brands now around $195 per share, that's roughly a $35 billion market cap. So there's, I think two aspects to this that actually make this interesting. One, that $35 billion market cap, there is a little bit of debt on it, so that's not getting factored in, around 3 times leverage, more than I typically like with my own personal portfolio. But the reason why I think this could be interesting for shareholders is, one, $35 billion, it fits in terms of the Berkshire portfolio if they wanted to make that move. I don't know if they'd sort of cross into it and say, hey, we're going to, get into the liquor business and, own that. There's one thing to have See's Candy and, raise pricing each year. It's another thing to say, hey, we made our move in the beer business. They could, in theory, but if at $35 billion, that's around 14 times ballpark free cash flow in the next few years, so around a 7% yield. So if you're able to get that 7% yield to shareholders, they could do buybacks, they could do, dividends. It'll be some sort of combination of the two. So if you're able to get that 7% yield and you're actually able to have a steady brand over time that maybe is either flat to up a couple percent, then you're talking about around a 10% return over time. And that gives zero credit for potential valuation expansion over time. If investors were to say, you know what, this is actually quite cheap given the mountains of free cash flow that they're generating, maybe it warrants closer to 20 to 25 times. And that would be how you could get maybe a 10, 15% type of return. So the just free cash flow plus little organic growth or maybe a little bit of pricing power, that gets you to around 10%. Then if you get the valuation expansion, now you're talking about a type of teens type of return. So I can understand why Buffett has been buying, or why Berkshire recently more than doubled their stake in Constellation, investing more than $1 billion in Constellation Brands. Even with the stock up slightly around 195, I could still see the value. And also there's a chance, as I already mentioned, that Berkshire could acquire the whole thing. Personally, I don't think this is right for me because they're facing some real headwinds with, just broadly, I think people drinking less, people recognizing it's not really a super healthy pastime. No judgment though. If you like, having, Pacifico after work or, something to take the edge off, I definitely understand some people doing that, but it's not, I don't, for me personally, the best thing for me personally is I take about 10 minutes, maybe sometimes 20 minutes if I'm going to splurge, and I just sit outside and meditate. And that, and my meditation's not even that great, but just closing my eyes and sort of zoning out, listening to some, the water running or a stream, that just helps my mind sort of clear itself up versus, saying, hey, I'm going to go, drink a few. But look, everyone has their own preferences. And the reality is if you study human history, alcohol has been around for thousands of years. So it's not going anywhere. Maybe the brands shift over time, but you consumer preferences might change, from year to year. But overall, it would surprise me if they really disappear, if Constellation Brands really does disappear over time. And what's his second position where he was doubling down? Before getting into that, first of all, please understand none of this is financial advice. I'm just sharing my own personal take, looking at what Berkshire recently doubled down on. Also, just earlier today, I was buying a stock that trades at roughly 6 times management's earnings target while growing revenue by over 40%. If you're looking for compelling ideas, come check out unrivaledinvesting.com, or as Pinkle, a premium member of the Unrivaled Investing community, recently shared, I have been with you for a year and it was a game changer for me. Thanks for creating this service. We have an excellent community. By the way, prices at Unrivaled Investing will be going up at the end of this month. So now is the time to lock it in. It will never be lower than the current prices, particularly for the premium tier. So looking at the recent transactions, recent purchases for Berkshire, it is important to have context. They're sitting on a mountain, $300 billion plus, $350 billion in cash. I did a whole video talking about how to value Berkshire, for the viewer that's more interested in thinking about how do I even, piece together, a $1 trillion company? How do I think about the valuation of where Berkshire goes in the years ahead? But so it's important to understand they have a lot of dry powder. They could buy a lot of things. They could buy, both Constellation and Pool if they wanted to. And they've recently, those are the two positions where they more than doubled their stakes. In the case of Constellation Brands, it's around 7%. In the case of Pool, it's now around 4% of the company. Pool is a smaller bet, only around $500 million versus Constellation, was more than $1 billion bet. But these are the top, sort of ads that I'm seeing that, gets my interest, especially given that they increased by so much, more than doubling. Once again, the same sort of playbook with Pool, multi-bagger over, 20-year time period, up over 1,000%. I love seeing situations like this where, you have this long track record of creating value, and then maybe you hit a speed bump. Maybe there's some sort of short-term challenge, and you view it over a couple of years and you're underwater. And then you go, has something fundamentally impaired this business, or is that long-term track record, that long-term potential still in place? And so when we look at, Pool, what are they? They are the world's largest wholesale distributor of swimming pool and related outdoor living products. They, have hundreds of different centers, but they end up selling to their end customers, literally hundreds of thousands of customers around the world. And so when you think about their business, it's predominantly selling to the builders, to the service professionals for the pools. So that's 80% plus of the revenue. Now, it's important to take a step and think about that type of business model. When you're selling to someone else that's going to then sell it or charge it to someone else, they care a little bit less about pricing than the end person. And that's an important dynamic because that means you're going to have a little bit more pricing power to say, yeah, we can, we could squeeze it out. We could, give you a little bit of bump. We can make sure we cover our inflation costs, because at the end of the day, if you're the pool servicer and you're the local shop that, is servicing various different people's homes, summer's approaching, people are going to say, I want to make sure my pool's ready. Got to heat it up, something, the pump broke, or you got to make sure your chemicals are right. You got to make sure the balance is just right. So you go to your local distributor who has the inventory based on ordering it from Pool or the various different pool assets, pool.com, I think. And so what you're looking at is, an end customer that's like, yeah, I just need it because I'm going to be selling it to my end customer, the individual house. The distributor is less sensitive to price increases versus the end customer. So that does make this business, I'd say, more valuable because you can more easily raise pricing over time. And you could also see when you're thinking about this business, so mostly to the professionals, the service professionals, somewhat to retailers, and then the smallest piece is commercial. In terms of end product application sales, you can see the vast majority is maintenance and repair. So you look, if you have a pool, you want to make sure the water's healthy. You don't want a bunch of people getting sick after they go swimming. So maintenance and repair is actually critical. So that's a recurring revenue type of business. And then you have renovation and remodeling, and you have new construction. So I would say 60% of the business is very clearly, the repeatable. The renovation remodeling, there's an element here of discretion. Do you actually need to remodel it, or do you just need to do the base, the bare minimum in terms of maintenance? Maybe the paint's chipping off the edge, or maybe the pump can get another season or two. So there is a little bit of, variability depending on, how the consumer wallet is doing and how interest rates are doing. Can I get that personal loan that finances, getting in the new lights and the new jets in the pool. So that you do have these dynamics that occur that impact this business. So, depending on the different investor, you could say at one angle, more conservative investor might say 60%, more aggressive might say closer to 85% is recurring in nature. But you still have this 14% that's tied to new construction. So if you have higher interest rates, higher mortgage rates, that 14% will come under pressure. Vast majority of their business in the United States. They are, approaching other markets, Canada and Europe, but vast majority in the United States, particularly thinking, states like Florida and California, Texas. And you can see there are various different products, equipment, chemicals, building materials, and all other. I think the reason why they're the number one distributor is because of this appeal of deepest and most diverse product offering. If you are the distributor in your local market, you just need to make sure you have the products. So you go to them and Pool says, yeah, we got you covered. You need a very specific type of chemical. Maybe, you want the salt water for type of pool. Okay, we've got you covered. Maybe instead of the chlorine, there's a lot of different ways to handle this. Looking at their financials, just a thing of beauty in terms of over time, looking at strong EBITDA growth, strong free cash flow. Looking at a business, the dark blue bars reflect free cash flow. It is a little bit bumpy, but you can see ballpark around $500 million, some years better than the others. Most recently, around $800 million in free cash flow. You can see, this is a cash generative business. That's why Berkshire likes it. They love these high free cash flow businesses, and they're using their free cash flow largely for share repurchases, also for acquisitions, tuck-in acquisitions. Over time that helps drive their growth along with dividends. They recently upped their buyback, increasing their quarterly dividend as well for the 20th time since 2004. So long-term, treating the shareholders well, with a lot of capital going back to the shareholders, the vast majority, share repurchases and dividends. Very similar story that you saw with Constellation Brands as well. A lot of the capital, free cash flow going back to shareholders. The challenge, however, with Pool is that you're really looking at a, business with flat growth. And I think that's, it's not driven by inflation / pricing, because they're able to, as I already mentioned, squeeze a little bit, each year, and they're expecting around 2% pricing increase, 1% from tariffs, so another 1% from just, them being able to get a little bit more. And they're saying maybe a little bit growth from maintenance, but with construction and renovation, that's probably just flat. And so all in, you're probably talking about flat. First quarter sales were actually down. And so that is sort of the challenge. So when we think about Pool, around $320 per share, that's around $12 billion market cap. Interestingly enough, on the most recent Berkshire meeting, they did allude to the fact that there was around a $10 billion company that they had considered acquiring outright. So that could fit with the Pool dynamic, because that's around a $12 billion. So, I definitely see Pool could easily fit in terms of the broader, their other operations, because Berkshire has so many. They have literally dozens of different subsidiaries. This could definitely fit well within their operations. So thinking about the operations, thinking about the current valuation, it's not dirt cheap, but I'd also say it's not unreasonable. Around 17 to 24 times normalized earnings, ballpark. You could say, let's just say around 20 times. So I'd say, once again, not crazy expensive, especially if you think, okay, this is a type of business with a little bit of pricing power, volumes probably over time continue to go higher. So you have, let's say, 20 times free cash flow. That's around a 5% yield. If you're able to get that 5% organic growth over time, then once again, you're getting close to that, 10% return that you could ballpark over time. And once again, that's how Buffett, I think was looking at these is, does this have a minimum of a 10% type of framework? And, for both Constellation and Pool, I think you can, ballpark pencil that out. Personally, I'm looking for things where in my low case, I could pencil out even more upside. But look, every investor's journey is different, and where Berkshire is today with $300 billion plus in cash, that's a much tougher challenge than you and I trying to figure out, hey, what's a compelling company that, I could make 20% of my portfolio, and, it's a rounding error for the company, but, it could be a game changer for the individual, trying to find those next multi-baggers that go up 1,000% like Constellation or Pool did over the last ballpark 20 years. So if this video has been helpful for you, please make a point of hitting that thumbs up, hit that subscribe button. Also, if you're looking for compelling ideas, come check out Unrivaled Investing. Pricing is going higher at the end of this month. Saying thank you so much for tuning in.